Welcome back to the deep dive. Today, I want to stress test one of the oldest rules in the investment playbook. You know the one. Safe as houses, specifically London houses. For decades, the logic was, well, it was bulletproof. If you have capital, you park it in prime central London, and you sleep like a baby. But we've got a stack of data here from January 2026. We're looking at analysis from the wealth managers at Rathbones and some market data from Hamptons. And it suggests this safety is, well, it might actually be a dangerous illusion now.
It's a massive psychological shift,
Yeah.
a really massive one. We're looking at a market where the fundamentals have, they've effectively inverted. I think the headline from the Negotiator really sums it up. Treating London property as the low-risk cornerstone of your wealth. That's now a mistake.
That feels like a drastic call, though. I mean, we're talking about London real estate. Usually when people worry about the market, they just mean prices might stay flat for a year or two. Dangerous.
Yeah.
Surely that's an exaggeration.
You'd think so, wouldn't you? But if you look at the actual scoreboard from last year, from 2025, nearly 15% of London properties sold went for a loss.
15%.
Yes, that's not a flat market. That is nearly 1 in 6 sellers walking away with less cash than they put in. Simon Bashurin from Rathbones is explicitly flagging this. He's calling it a wake-up call, especially for high-net-worth families.
Okay, 15% sold at a loss that's startling. But let me play devil's advocate for a second. London has dipped before. Why is Bashurin so convinced this is structural, not just a cyclical dip we can ride out?
Because the rules of ownership themselves have fundamentally changed. Bashurin identifies what he calls a triple threat. And this just didn't exist in the same way in previous cycles. You have concentration risk, extreme illiquidity, and a hostile tax environment.
The illiquidity must be a huge factor.
Oh, it's the silent killer here. In the stock market, if things go south, you can exit in seconds, right? But in this 2026 London market, you could be stuck for months, maybe even years.
And while you're stuck, you're paying for the privilege. The report mentions a squeeze on holding costs. What does that actually look like today?
It looks like negative carry. I mean, that's the bottom line. We have the higher stamp duty surcharges we've seen, plus the mansion tax is now fully biting. And then you have these looming council tax supplements on top of that. So you stack all those rising fixed costs against rental yields, which haven't kept pace. And you get what Rathbones calls diminishing rental viability. Essentially, the house is eating your cash flow just to sit there.
So it costs more to hold. You can't sell it easily. That sounds annoying for a retiree. But Rathbone seems to think it's catastrophic for estate planning. Why does this specific mix ruin an inheritance?
This is the critical insight. This is the bit that usually gets missed until it's way too late. Most people assume their property portfolio works like a business asset, but doesn't. Residential property generally doesn't qualify for something called business relief.
Meaning there is no tax shield.
Yeah.
At all.
Zero. None. The full value lands right in the middle of the inheritance tax calculation. And because those tax thresholds have been frozen for so long, that bill can be massive. Now, combine that with the illiquidity we just talked about, a parent passes away, and the estate suddenly owes this huge tax bill that has to be paid, promptly. But the main asset is a London house in a frozen market.
Right. I see the trap. The family has to sell to pay the tax, but no one is buying.
Precisely. It becomes a distressed sale. The market smells blood. Buyers know you're desperate. Valuations are all over the place, and liquidity is just dry. You end up forced to accept a fire sale price just to satisfy the tax man, so you aren't passing down wealth. You're passing down a liquidity crisis.
Wow. That completely flips the script. The very asset that was supposed to secure the family legacy becomes the thing that dismantles it.
And that's the core takeaway here. Rathbones isn't saying don't own property. They're saying stop viewing it as the safe haven backbone of your retirement. It's now a high-risk, illiquid asset. It requires totally different handling than it did, say, 10 years ago.
So it sounds like a call for serious diversification. You just can't rely on the postcode anymore.
Exactly. If you can't liquidate it to pay the bill, it's not a safety net. It's a trap.
A sobering reality check for 2026. And it leaves us with a question you should probably ask yourself. If London real estate, historically one of the world's premier safe assets, is now flashing red warning lights, what other safe assumptions in your financial plan might be resting on old rules that have quietly expired?
That's the question.
Thanks for diving in with us. We'll catch you next time.